everyone. Welcome, welcome to another edition of Strategic Financial Management. In today's class, we shall look at shareholder value analysis. Shareholder value analysis is a technique, is one of the technique of valuation. Don't forget that free cash flow to the firm to equity is a form of valuation. Merger and acquisition, when you want to merge or acquire business, you do a valuation of a business, either using free cash flow to the firm or free cash flow to equity. Economic value added is a form of valuation as well, because you want to know whether you add value to the shareholders at the end of the period. Shareholder value analysis is also a technique or a form of valuation of a business. So you can use any of these methods to say, okay, I want to know the value of my shareholders, right? Now, the question is, what is shareholder value analysis, right? Shareholder value analysis is like, let's say, is the process of analyzing the activities of a business to identify how they would resolve an increase in increasing shareholders' wealth, right? How do we increase shareholder value? How do we increase shareholders' wealth? Don't forget, at the beginning of our lecture, we talk about maximization of stakeholders, right? Wealth, right? Increase in the profitability, right? Increase in profitability, cash flow, they are liquid, right? And so on, right? And that is, if you have that kind of sign, okay, it indicates that you are maximizing, right, shareholders' wealth, right? Now, in a nutshell, shareholder value analysis, it is an analysis, okay, or is the process of analyzing, right, the activity of a business to identify how they would result in increasing shareholders' wealth. How do we do that? You have to do a shareholder analysis, right? How do we increase shareholders' wealth, right? Now, the concept now believes that in increasing the shareholders' wealth, class, the concept now believes that in increasing the shareholders' wealth, there are factors that affect that we not be that affect the shareholders' wealth, maximization of shareholders. There are some factors. These factors are called seven drivers, right? It's like this particular topic is to just be like um um kind of let's say like a story. Let me just put it that way. So it's like I'm just explaining the process of how it was, right? So there are factors that do what? That affect that affect the maximization of what? Of shareholders' wealth. And what are these factors? They are called seven drivers. That is, in the process of maximizing shareholders' wealth, in the process of increasing their wealth, there are factors that affect the process. And this factor is called seven drivers. And what are the seven drivers? it talk about the sales growth, right? The sales growth. If the sales is not increasing, it could affect the shareholders' wealth. It may decrease the shareholders' wealth, right? Right? But if there is an increase, it could increase what? The shareholders' what? Wealth, right? Another driver is the tax being paid, right? The tax being paid. If the company pay higher tax, it could affect because it could affect the shareholders' wealth. Why? Because what they will pay to investor is from their what? Is from their profit. And if they are not, you could see that it is it is raining dividend. It is what? It is raining dividend. So many companies are declaring dividend, right? I want to digress. Now, when they are declaring dividend, dividend is being declared as a result of the profit being made for the period. You could see Gcode declared a dividend of about 7 naira, right, per share. What does that mean? It means that the shareholders who are who are interested in dividend, right, we take their return on investment 7 naira per share. So it now depends on the numbers of shares, right? Now, that is those investors who like what? Dividend. Now, what I'm saying here is that if if now let me move a little bit. Now, when the company now declare the dividend, we will now take us to what we call efficiency market hypothesis, or it will take us to what we call market information or market timing. Why? Because the market is red now. Investors react to what is happening in the market. Immediately companies declared dividend, what will happen to the market price? The market price will increase, right? The market price will what will increase, will be overvalued, right? Under portfolio, so it will be what? Overvalued. Investors will not want to buy more. Is that not so? So immediately the company pay the dividend, go and check. The market will be growing. What is the implication? It implies that the market price will drop, will be undervalued to bring in new investors to do what? To buy more shares. What I'm saying here is that the tax, if they make more profit, right, they will pay high dividend. Now, another drivers that actually affect them is uh, is increase in non-current asset or the purchase of an asset, right? When they purchase an asset, the question is from which place did they purchase the asset? Is from their cash flow, right? Is from their what? From their cash flow. Now, how did they purchase the asset? Is it that they use part of the profits to buy the assets, or what did they use? Don't forget the depreciation part of it will be in the profit or loss account. Is that not so? So the increase in the non-current assets actually form part of what is part it form part of the 7 drivers that could affect the shareholder, that could make the shareholder not to do what? Not to what? Not to increase their wealth. Another thing is the life, another driver is the life of a project, right? If the life of a project, it depends, right? If the life of a project is 4 years, right, the inflation could actually affect. So why can't you make it maybe 3 years to 4 years? Although they may actually have their reasons why they have to do it 4 years or 5 years, right? So that if you do a project to be, let's say, 4 years, it means that at the end of 4 years, investors will recoup back their investments. Is that not so? So the life of a project could cause why could is also form part of the what, the seven drivers, right? Now, which other factor? I've talked about the sales growth. I've talked about the life, the tax, the life of a project. Then I need to talk about the operating profit margin, all right? The operating profit, right? Operating profit margin is part of the drivers, right? Now, if the operating profit decreases, now it could be that the cost of sales will enter actually with what I'm even explaining now is analysis, right? I'm going into analysis, what, business analysis, right? Now, when the operating profit decreases, right? What could what could what could be the reason why the operating profit margin decreases? It could be because the cost of sales increases, right? Increases. And when the cost of sales increases, it will affect the profit margin. So this could also cause part of the drivers that may not allow, if there is a decrease in operating profit margin, it could affect the shareholders' wealth, right? What other factors should we be looking at? We've talked about the sales, we talk about the tax, we talk about the operating profit margin, we talk about the life of a project, we've talked about the non-current assets. Which other one? Remaining two. Which other two should we add? Class. Which other two should we add? Hello. Now, we could say increase in working capital. Don't forget that the concept of shareholder value analysis, right? Okay. The concept of shareholder value analysis is still explaining the form of valuation. That is, when you want to value a business, you could use shareholder value analysis. Now, when you want to use shareholder value analysis, now it could be free cash flow to the firm or free cash flow to equity. Class, it could be the free cash flow to the firm or free cash flow to equity. It depends on the question. You want to have the value of the business, right? Using what? The concept of shareholder value analysis. Class, am I communicating, please? Am I communicating? That is what bring about shareholder value analysis. Class, are we still together? Who is against me in this night? Okay. Now, we are not talking about question, oh, Benjamin. Now,
Sorry, I wanted to give you thumbs up that I'm with you.
okay, that's fine, well done. So, what am I saying, sef? Okay, where did I say increase? Okay, I'm talking about the increase in the working capital. Now, what bring about the value-based management, which is under the value-based, there is shareholder value analysis. Let's say shareholder value analysis is talking about is another form of valuation of the business, right? When you want to value the business, they could say, okay, using the shareholder value analysis, what is the equity value per share using the shareholder value analysis? All is to determine the value of the business. Then that is why the definition now says that the shareholder value analysis is the process of analyzing the activity of a business in resolving to the what increase in the what shareholders, right? We want to ensure that we add value to our shareholders. Is that not so? Now, in the process of adding value, there are what we call seven drivers that could what? That could affect the what? The value of the what? Of the shareholders. Now, out of it, I now explain the sales could affect, right? Could affect if there is a decrease, right? If there is an increase, it will not affect, right? Because it will add value to the what? To the shareholders, right? I talk about the tax being paid, then the operating profit margin. Then after the operating profit margin, I talk about the life of a project. Upon talking about the life of a project, I talk about the purchase of non-current asset. Something should just come to your mind. I'm listing what I'm bringing out is like an items that we use in do what in calculating free cash flow, right? The next thing is the increase in working capital. When there is an increase in the working capital, it will decrease the cash flow, right? It will decrease the cash flow. With this will have impact in the value as well, right? The last one is the cost of capital, right? Either the equity or the debt part of it, right? The cost of what? Capital, the cost of borrowing, right? Now, these are what we call the seven drivers that could affect the value of the shareholders, right? Just like when you want to buy shares now, right? What are the things that could affect you, right? that could affect you, that could affect the company, that it will actually touch you indirectly to make your what? To make your profit to do what? Or to make your dividend to decrease, right? If their sales is not growing, right? If their sales is not growing, if they have more working capital to finance the business and all that, right? These are the things they will consider before they will say, okay, we want to pay you a specific what? Dividend. Distinguished professional colleagues, question before we solve one of the past questions. Now, the statistics now shows the diet Ican just tested this question using the shareholder value analysis everywhere. Like they say, about 20% of the students attempt the question, but guess what? They fail it woefully, right? It is off points. It is what off points. So that is why I decided that okay, let's touch shareholder value analysis. Then by tomorrow, fully tomorrow, we will now introduce foreign exchange. Our introduction to foreign exchange, we are not going deep into foreign exchange. Don't forget, I've mentioned it. We will pick elements, what items that we will use when we move to what? International investments, right? International what? Investment, right? And that is what we want to do. Okay, question please. Before we look at past question.
Hello, sir. I'm not clear on increase in non-current assets, then the life of the project.
Yeah, it's still the
Mhm.
same. Picture it the way it is under the free cash flow.
Okay, sir. Thank you, sir.
Yeah, yeah, okay. Still the same thing. Okay,
So, so
I'm with you. I'm with you.
yeah, in the text, I was just looking at the text. The text, there was something there that says competitive advantage period. Is that is that supposed to be like the length of the project or something like that too?
Yes, 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 yes.
Okay, okay, sir. Thank you.
Uh, Any other question, please? Okay.
Good evening, sir.
Good evening.
Yeah.
Good evening.
Sorry, I don't know. I don't know if it's from my own network, although my network has been cracking. But I'm not seeing anything you are presenting so far. I've tried to switch network from one network to the other, so I don't know.
I didn't even present
And I
anything.
know I did, maybe possibly later I will check again. I didn't get even anything at all because
Oh,
my network has
okay.
been off and on.
Okay.
Maybe when I replay it, I think I will get, or when I see the material, to see if I will
Okay.
get it.
Okay, that's fine. That's fine. That's fine. Now, okay, let me use like 20 minutes to explain something again. It's another topic, but I've been mentioning it for those who have been following our lecture. I've been mentioning it often and often time, uh, which is I made mention of reconstruction and reorganization, and I still made mention of divestment, management by out, management by in, and all that, right? In fact, under financial planning as well, I made mention of that. I think we solved one question that talked about divestment, the management by in, management by out, and all that, right? Um, One thing I've noticed again from the past question is that the question is not as difficult the way we chase, the way people look at it, right? That is, this question is difficult because what makes it so difficult is because of the exam tension and all that. But guess what? Just have the confidence that you can do this thing. It is what you know. Imagine question like differentiate between the sources of finance. Maybe they talk about the debt and equity. You should explain. As in, you should be able to write at least a page for the two, because you should be able to say, okay, this is debt. Explain debt the way you understand debt as a whole. Explain equity the way you understand equity as a whole. Don't allow them to use one English to confuse you. It is explain it like that, right? Now, what I'm saying this is there are some marks that we need. It is very important. Let me just take us through that. Again, it is another topic on its own, but let me just quickly let's just talk about it. There is what we call reconstruction and reorganization, right? What is reconstruction? Reconstruction is when a company is having a financial challenge. That is, they were not able to meet up with their long-term obligation or short-term obligation, right? They were not able to pay their suppliers, right? As and what? As and when due. That is a reconstruction. Because we will need these terms in intensive class, right? The reconstruction. We will need it because there's a question I look at, right? The first question is explain the concept of reconstruction and reorganization. Then, what is the reorganization? Now, if there is a financial difficulties, class, if there is a financial difficulties, what is the way forward, right? What will be the what? The way forward. If there is a what? A financial difficulties, they could do what? Revalue their assets, right? They could do what? Revalue their asset. They can actually merge with other companies. Is that not so? They can actually do what? Merge if they don't have enough finance. They are having a financial difficulties, right? Now, what is reorganization? Reorganization, reorganization is the changes in ownership of a business. I will give you an let's quickly look at the practical illustration. You have a business that is divided into two. You have the business, maybe one they produce milk, the other part sugar, right? Then you look at it that this sugar, this sugar as a unit is not bringing anything to the what? Is not, is not performing well. Let me put it that way. It is not what? It's not performing well. Then you could say, oh, bring in what we call divestment. You sell it. You sell it. Divestment means that you sell it. You sell the business that is underperforming. The unit is not doing well, right? You sell it, or you say, okay, since this sugar part is not doing well, let can we merge? Now, in the process of merger, don't forget, loss of proportion of ownership is one of the disadvantages of merger and acquisition, right? Now, in that process, the percentage you own will be what? Will reduce as a result of that. So, reorganization is that it occur as a result of changes in ownership. Changes in ownership occur when one of the business units is underperforming, right? You could do what we call reorganization. Class, you could do what we call what? Reorganization. Now, you can advise as a financial analyst or as an investment, and you could say, okay, let's do something. Okay, let's can we do merger? Can they merge with other business? Okay, what could have happened to Heritage Bank that they fold up? What could have happened? Could that be that they didn't see it coming? Could that be that there's a financial issues? Could it be that a lot of things, right, that we don't know? But a rational investor that knows what he's doing will not go there and say he want to invest in Heritage Bank, right? Even before now, before they close operation, right? Now, what I'm saying here is reconstruction is different from reorganization. Reconstruction, they are having the financial difficulties, the business as a whole, right? Now, reorganization is that there's a change of ownership as a result of one of the business units is underperforming. As a result of that, you could go into what we call divestments, or you could do what we call management buyout under divestment, management buyout, and management buy-in. Listen to class, because these are part of SFM that 2 marks, 3 marks, you move on, right? What is management buyout? It's a form of diver. You can decide that you want to, okay, let's do management buyout. This particular unit is not performing. Okay, let's sell it. Management buyout means that you are selling part of the business to who? To the management. But there is the problem. This same management, what are they doing? That part of the business is not performing well. What are they doing? But you still want to sell that business to them. Can you see it? They could allow the business to fail, to fold up, and they knew that, okay, they will sell it to them. Management buyout, they will sell it to them. Is that not so? They could allow it. So there's a problem there as well, right? Then management buy out. I explain management buy out. The management buy in, right? You sell it outside. You don't want to sell it to the management. If I'm the owner of that kind of business, I will not even sell it to the what, to the management, because I will ask question, what are they doing that this unit actually what further, right? Then the management buy in, you sell it to the what, to the external, right? Another form of reconstruction, you could say, okay, let's do merger, right? Merger, right? Then, yes. So, and that is it. Class, am I communicating, please? Hello? Okay. So, can we solve question now? I'm just kind of, I just need to like explain that part. But if you have question, you can unmute your mic. You can unmute your mic. If you have question, you can unmute your mic.
Exclusive.
Where is the who said exclusive? Voila. Who said exclusive? Someone sent me private message, and he said after he mentioned that he comment something explanation and thereabout, and he now said kudos to the consistent guys. I said, who are the consistent guys? Exclusive Sam. Exclusive Sam. Honestly, they've actually been consistent, and even Favor has actually been consistent with lecture as well, right? Because I know those who are guys. I know those who have been consistent with lectures and thereabout, right? Actually mentioned. Avina. So do we have anyone that have question? Olawale, me too, get for where? Rachel, do you have question? Are we good?
Yeah, I'm good, sir. Thank you, sir.
Okay. So please, these are small marks that we can capitalize on, right? Right, please. These are small marks that we can capitalize on, right? Okay, now let's check November 2022. Let's check November 2022 question 5. November 2022 question 5.
Hello, sir.
Yeah, I'm with you.
Hello. Yeah, I said, how about converting some of the debt holders to equity shares? Under what category will it fall? Is it restructuring or reorganization?
Reorganization, not reconstruction. Reorganization.
Okay,
Thank
all
you.
right.
That is a very good one. It's under is financial difficulties. The company as a whole is under reorganization. It's under reconstruction. Sorry, it's under reconstruction. That is one of the advice that we could give them, right? Those people who are equity holders, they can convert, right? They can actually convert. That is a very good one. Please, someone should send let's someone should send it to the platform so that we can move from there quickly, so I will move. So are we there?
Sir, what year, sir?
November 2022 question 5. Question 5. Question 5. Need to download it on the system. Oh, need to download this on the system as well. Choke. The question, you will get it. The question that we want to solve now is November 2022, question 5. Do you get Olanike? Olanike, are you
Are you
still with
still?
us?
Yes, thank you. I've gotten it.
Okay. So are we good now? Is the question in the platform?
I think I shared it.
Let me know if we are ready. Since we are not ready, right? So let me just relax. Have you shared it?
Yes, I did, sir.
Okay, that's fine. So don't forget that the drivers are all components that we use to determine our free cash flow. Don't forget all this. That when they just mention using shareholder value analysis, either they say, okay, calculate the equity per share using shareholder value analysis, right? Madam Linda, you were not in class yesterday. What happened? Hope all is well.
Yes, sir. Thanks for checking on me. I wasn't feeling that
Okay, yeah.
strong. Yes, sir. Thank you,
Oh,
sir.
okay. Yeah, welcome. Sorry. And who again? I think someone is consistent. Okay, so we are good, right? So please, someone should read for us. Can someone read the question? Permisire. Oh, she's not in front. Uh, Favor. Favor, please read the question. Let's move on, please. Hello.
Hello, sir. Is it the one with Ade Propoko
Yes,
PLC
yes. Question 5.
or something
Yes,
like that?
sir.
Okay,
Okay, may I proceed? Okay, favor is around, no problem.
question 5. I do call PLC.
Oh, no,
You've had
favor, I beg you. This your bedroom voice. I just hold am there. Uh, hold am there. I beg. Who can read now? Who can read? Who can read? Apart from favor, leave favor though.
Let me try and
Okay,
see.
Olanike.
Can I try and see?
No, Olanike. Ooh. Oh, Benjamin. Benjamin, that your voice. No say when make I no talk. Let me just Olanike.
Okay, sir. Aderupoko PLC. Okay, let me start from the requirement. Sorry. Calculate the value of APL's equity using SBA. That is the A part. Then the B part, outline 3 methods by which APL's directors might raise funds necessary for the proposed MBO of the company. Aderupoko PLC, a large listed media group, has been the holding company of Adamu Publishers Limited since 2015. The publishing company is 100% owned by ADC since inception.
Okay.
Recently,
Now. Just hold on. Please, the other person should mute his mic, please. I don't know which person's mic is on. Please, if you are not talking, please mute your mic, please. Thank you. Just a minute. I need to get the question. Come a minute. Want to find. Sorry, Adenike. Olanike, sorry. You will have to. I've changed your name, Adenike, Olanike. Oh. Please, we have to start again. You have to start again, sorry. I need to get something from the required.
okay, sir.
Do you get that?
Yeah. Okay. Required. A. Calculate the value of APL's equity using SBA. B. Outline 3 methods by which APL's directors might raise the funds necessary for the proposed MBO of the company. Okay. So the question. Aderupoko PLC, a large listed media group, has been the holding company of Adamu Publishers Limited since 2015. The publishing company is 100% owned by ADP since inception.
Okay, just hold on. What happened? This thing is echoing.
I think she should be quiet.
Okay. Thank you. So I think when I want to talk, you just mute your mic, right? Okay, now what really happened here is that ADP has been the holding company of Adamu since 2015. The publishing company APL is 100% owned. So which means that APL is owned by ADP, right? APL 100% is being owned by ADP, right? And don't forget, they say it has been the holding company of Adamu Publishers Limited. Has been the holding company, right? So it could be that ADP is the parent and Adamu is the publisher, right? Which could be part of the unit, right? Could be a subsidiary company. Then whereby ADP now owns all 100% shares in what? In APL, right? Now what happened? Go ahead, please. Hello?
Recently, the directors of APL informed ADP's board of their readiness to make a management buyout of APL. Accordingly,
Hold on. Sorry. Now you can see the management of APL now inform the board that okay, we are ready to make management buyout, which means that APL will form part of ADP, but maybe different shareholders, right? Now, they are not saying that, okay, we are willing to make a management buyout of APL. Then the question is, what is management buyout? Management buyout, you sell it, you are selling that business, part of the business, you are selling it, you are selling APL to the what? To the internal management class, to the internal what? Management. That is why the question now says in the B part of the question that, okay, outline three methods by which APL director may raise the funds necessary for the proposed MBO of the company. Now, if they want to sell this APL now, they will sell it to the management of APL. They will sell it to the management. They will sell it to them, right? That is management buyout. Now, the question now say, outline three. How will they source for the funds? Where will they get the money from? This is why the question says that outline three methods by which APL director may raise these funds necessary for the proposed MBO of the company. 3 marks. Please go ahead.
Accordingly, ADP's board decided to value APL using the shareholder value analysis method. ADP's board estimates that APL has a 4-year competitive advantage over its competitors to 30 September 2024. And the following data regarding APL's value, drivers, and additional financial information has been collected.
Okay, thank you. So, this ADP now board decide that, okay, to value APL, we have to value APL using the shareholder value analysis. Then the ADP board estimates that APL has, that is the competitive advantage, that is the life of, let's say, it may not be a project, the life of the business, right? Has a 4-year competitive advantage, 4 years, right? 4-year competitive what? Advantage over its competitors to 30th September 2024. And the following data regarding APL value drivers. These are the drivers, right? And additional financial information has been what? Has been collected. These are the drivers. You could see that the sales for the current year to 30th September 2020, the sales is 80 million. This question is a very technical question. And it is simple. Like when you look at it, you look at it that, okay, this question at least, but it is very technical. And what makes it technical is that you have to unlock some things, some items here, right? Now, the sales is 80 million. Favor, please, when it is 3 minutes to end this meeting, let me know, please, so we can create new link. Do you get?
It's 4 minutes already.
Oh, okay, it's 4 minutes. Okay. So I think we need to create another link so we can continue our lecture. Our class tomorrow, being public holiday, we should start early, maybe 2:30, right? Tomorrow class should be okay, maybe after the class we'll talk about it, right? So being public holiday. Okay. APL has a competitive advantage over its competitors for 4 years. Then we're given the drivers, the sales for the current 30th September 2020, is this. Then annual depreciation equal to the annual replacement of non-current asset expenditure. What does that mean? It means that the figure given to us as annual depreciation will still be the same figure for replacement of non-current assets. That is what it means, class. The par value of 6% debenture issued, that is the debt. The current market value is 95, should be 95 naira market value. Okay, maybe 95 million or 95 naira, right? The nominal value is 100 when we have the total figure given to us is 10 million. The there is a short-term investment held. Short-term investment that was held 0.8 million. Then there is company tax rate of 20%. Then what we're given here is weighted average cost of what? Weighted average cost of capital. Right? Now we move again. The year to 30th September budgeted. Don't forget, the competitive advantage is for 4 years, which is to 30th September 2024. Right? Then the sales goods for 2021, 2022, 2023, 2024. So why do we have 2025 plus? 2025 plus here means beyond. That is to infinity. That is from year 5, which is 2025, to infinity. That is what it means, class. This 2025 plus, because the competitive advantage is for 4 years, but we will now have 2025, that is beyond. So operating profit margin is 8%. So which means that when you want to get your operating profit, it will be 8% of the sales, 9% of the sales, right? Good. We get it. Incremental non-current assets. Incremental non-current asset investment as a percentage of sales increase. I think someone asked a question, and I like the person respond, right? I think for every 1 naira increase in working capital, something like that. I like that question because it tests your knowledge on the increase or decrease, right? Now, in this question again, as a percentage of sales increase, class, if you grow 2025, this is for 2020. You use the 2020 sales to grow to get 2025. Now, if you grow it by 5%, you have a figure, right? And the increment in non-current assets, is that the 5% will be of sales increase. What is the difference between the 80 million and the growth? So the difference, you do what? You multiply it by 5%. It will give you the incremental non-current asset because it is as a percentage of sales increase. What is the increase? From 80, you will increase it by 85 by 5%. So what is the increase? So if you have the increase, let's say for instance 9 naira, so you multiply it by 5 to get your what? To get your incremental non-current asset. So the same thing applicable to incremental working capital. Working capital investment. You look for the difference of the sales goods, you multiply by 6 to have your incremental working capital. And don't forget that equally to annual replacement of non-current assets, you will have a replacement of non-current assets equally to annual replacement. So what it means is that you will still have replacement of non-current assets, which is 2 million equal 2 million, 2 million. You will have 2 million, 2 million, 2 million. That is equal, right? Now, what else do we need? The question says, calculate the value of APL equity using SVA. Distinguished professional colleagues, this is pure free cash flow. Then, don't forget, under the merger and acquisition, you were given that calculate the free cash flow to the firm. Then the question is like, calculate the equity per share. Calculate the equity per share. And the free cash flow is free cash flow to the firm. Let me remind you, what did we do? We removed the element of debt. Is that also? So in this question as well, equity, but you are given what? The weighted average cost of what? Capital. Don't stress yourself. Just don't give yourself unnecessary headache. What you just need to do is to do a free cash flow. Prepare a free cash flow. So what? To the firm. You have the market value, then you deduct the element of debt. Is that also? You deduct the element of debt. So once you deduct the element of debt, you have the equity. Class, am I communicating? Okay. So suggested solution, November, is it November? November 2022. The years 2021, 2022, 2023, 2024. Then this is 2025 beyond. Now, another thing is that what if in the question, right? There is no plus here. I don't think I have plus 2025. 2025 plus. Now, it is logical that we just have to look at it in this part that the competitive advantage is for 4 years. So why do you have 2025? That is the first question, even if you did not see plus here. Then, when you ask this question, now you could conclude that, okay, that means that 2025 is the beyond, because sorry, please, minutes. Please, can you see the question? I'm not sharing my Microsoft Word. Please confirm if you can see the question.
I can't see you.
I can't see.
Ah,
Sir, are you sharing the question on your screen?
yes.
Or from the WhatsApp? No, you can't see that on your screen.
Anyway, could have been the reason. Um, It's our network. I don't know what is happening. Let me. Uh, yeah, I have to log. I have to log out. So, what of now? Can you see it now? No? Yes or no?
No.
Oh, okay. Please just give me some minutes. I have to log out. Mm, thank you. Can you see the? I'm sharing the question now. Can you see it? Please confirm if you can see the question. Hello?
I can see.
Okay, okay, okay. Okay, that's fine. So, what if, my question is, what if there is no plus 2025, right? What will you do? Because the competitive advantage is just for 4 years. So, anything that is after the 4 years, that is beyond to infinity, right? So, in the last year, we could have beyond, right? Oh, oh. We could have beyond, right? 2025 plus. That is beyond. So let's start. The sales revenue goods. Now, what we want to do is to calculate the free cash flow to the firm. When we calculate the free cash flow to the firm, we will remove the debt element. Once we remove the debt element, we will have the value of equity, right? We'll have the value of equity. Class, am I communicating? Are we confused? Who is against us or against me this night? Where is exclusive? Okay, so is it million? Okay, million, right? Okay, so we can have something like this. Please, presentation. Always present your work very well, please. Right. So this can have this. Now, what is the sales goods? The sales will increase by how
By
many percent? So, okay,
5%.
okay, that's fine. I agree. Sales goods. So the normal sales is 80 times we increase by 5%. That is 1.05, right? So
Yes, sir.
what do we have?
84.
84. Next, if you increase it, what do you have again? For 2022.
87.4.
No, they gave us the increase for 2022, right? So
Yes, 4%.
4%. Thank you. So what it means is that the increase for 2024, right? 2022. So now the question is, which one are we increasing? Are we increasing this 84 or we are still increasing the 80? Which one are we increasing now?
84.
84, right? 84. Okay. So when you increase the 84, what do you have? By 4%.
87.
87. Next, 2023, sometime, what we've been doing so far, they may give you only one sales good, right? Maybe 5%. So you just grow everything, right? So in this question, you were given different growth rate for a different year, right? So what do you have here?
90.
This is 90. Next, sorry, the name of the company,
Aderukpoko.
determination of free cash flow. Okay. Free cash flow to the firm. They will now do the equity, right? Let me put to the firm. Free cash flow. mm, Then we'll remove the debt. Let me just put it this way. Then the name of, we should calculate for the required coming APL, right? APL. APL. Please always write it in full, right? All these things that are just one mark, right? It counts. So next, 2024 is what?
92.
92. So 2025 beyond, you increase it, what do you have?
0%.
Okay, it's 0%, okay? That is zero now, Abby. Is that not so?
Yes. Yes.
92,
So
92.
if this is
92.
established, what?
It should be
It
92%.
shouldn't be increased in 2025. So that's 92.
Okay, there is no increase, right?
Yes, no increase. 0%
Oh,
increase.
okay. Thank you. Now, if this is your sales, do you know the reason why I draw this line? Because operating profit margin is given. And we were told that the operating profit margin is 8%. So which means that when you want to determine your operating profit will be from your sales. Class. We did something like this in our previous lecture, right? Merger. So it is 8% of the sales will give you the operating profit, right? Operating profit, right? 8% for the first year, 8% of sales. What do you have? 8% of sales,
6, 7.
is 7.
Yes. Actually did 8% of 84.
Yes, 8% of 84. Yes. Next, how many percent operating profit
8,
margin for
8,
2022? What do you have?
8%. 8,
8, 8%. Next,
9, 9,
okay, 9. Next,
9 again.
okay. Out of the operating profit margin,
9 as well.
okay. So what else do we have from our,
Incremental non-current assets.
okay, thank you. Thank you. Incremental non-current assets will arise as the difference in the increase of sales. Please pay attention to this part, right? So I don't want to do the working, so I want to believe that we've been doing free cash flow since, right? So incremental non-current assets, right? Now, the incremental non-current asset will be calculated as, let me say, workings. I'll just do for year 1, right? Will be, is based on sales, right? Incremental
Yes, sir.
non-current assets. So as a percentage of sales increase, right? Is English. The first sales that we have is 80 million in 2021 minus the increase in 2021 is what? 84 million, right? Times, what is the increase for incremental non-current asset? What is the increase?
5%.
Times 5%. So what do you have here?
That's 0.2.
0.2. You do the same thing with this.
But the others have been having decimal. I've not been putting it in. Is it okay?
Don't worry now. It's 0.2. So what is the decimal for all this? What is the decimal for this?
Okay, let me go back.
I should have put, what is the decimal? We'll just use one decimal. Quickly, others should check now. Others should check so that we can move,
That
please.
was
It
6.7.
will be from the beginning. From
6.7.
sales.
No, we can leave the sales like that. We can just leave the sales like that. Okay, you approximate this, right? You approximated this to
Yes,
7.
to 7.
Leave it, leave it. And leave this one at
Yes.
0.2. You just leave it. Incremental.
Okay.
So what do we have? You do the same thing. So you compare 84 minus 87. Is that not so? So you do the same thing. Let's say for the
Yes,
second
sir.
year will be 84 million minus 87 million. What is the increase? Times
6%.
6%. So what do we have here?
0.2.
0.2. Same thing, 0.2.
0.18. So I'm approximating again.
0.118.
8.
Okay, that's fine. Who is that? Do you have anyone that have question? I think someone is. Okay, Olanike.
Thank you, sir. I think we are trying to get free cash flow to the firm, and based on the method you taught us, before this incremental non-current
Thank
asset.
you. Thank you. Thank you. Thank you. Thank you. Thank you.
Yes.
Thank you. Thank you. So before the before the incremental, we need to have the profits. What is it called? The profit after tax. Is that not so? When we have profit after tax, we now do add back non-cash items. Is that not so, class? When we
Yes.
do add back so that is what we're supposed to do. It is well. And everybody, you are giving me figure. Eh? Uh, favor.
Take
Exclusive.
out. Take.
It is well. Okay. So this is operating profit, right? So after the operating profit, right? Are we told that depreciation is inclusive in the operating profit? Because this is an area we need to look at. Is the depreciation inclusive in the operating profit? Is it stated? Now, operating profit margin. The question is, what will give us operating profit margin? Could that be that we have considered depreciation before then? Class, are we still together? Hello?
We are together, sir.
Am I the only one in this class?
We're together. We're together, sir.
Okay, I'm asking question that could that be that operating profit the annual depreciation has been included in the operating profit? Could that be so? Because they didn't actually specific that, okay, maybe depreciation is inclusive. When you have your operating profit, what make up? Don't forget that when you are classifying expenses by function, um by nature, sorry, I think by nature you should have, sometimes you could have consider sometimes based on the company policy, depreciation may be included in the and what make up the operating profit is your cost of sales. Is that not so? So depreciation might have been included in the cost of sales, right? Now in this question now, we're not even told that probably this is what happened to depreciation. Is it included in the operating profit or is it excluded in the operating profit? Please, are we getting my point? If not, we would have said, oh, depreciation,
Yes, sir.
we less the depreciation again. But I think depreciation has been included. We will not say depreciation again. What are we going to do? We just say, okay, tax. Then after the tax, we will now say, okay, add back depreciation because depreciation has been included in the operating profit. Class, am I communicating, please? Am I communicating, please?
Yes, sir,
Ah,
you
the
are.
answer is
Yes, sir.
Okay, so now in this case now, we can assume that the depreciation has been included in the operating profit, right? Because we cannot separate it as after the operating profit when it is not even stated, because we're told that the annual depreciation is equals to the annual replacement. So which means that your depreciation is your is your replacement, and it is annually, which is 2 million, right? Which is 2 million. So how should we treat this now? Should we, because it is not actually stated that operating profit is included, and in the required it wasn't stated that we should state any assumption used. So what is the way forward, class?
In my opinion, I think we should ignore. We should not. We should not assume anything. So we should just leave it the way the question is. That's my opinion.
Okay, that's fine. So any other person? Okay, so what do we have here? Tax. What is the tax? How many percent? What is the tax? How many percent is the tax, class? Hello, please, can you hear me? Wow, interesting. I think network is. Hello,
We can
Favor.
hear you, sir. We can hear you, sir.
Okay. I think the network threw me off. Okay, what is the tax rate? 20%, right? Hello,
Yes, sir. 1.4.
everybody is saying it. We have about 21 participants here.
Is the network.
Taxation is 20%.
The network is not too good to my end here. I'm just on and off.
Okay, that's fine. That's fine. So if you charge 20% of this, what do you have?
1.4.
Okay, you just managed to hear. Sorry, the network is just 1 point what?
1.4.
1.4. I think the network is not good this night. I don't know what. Next,
1.6.
4.6.
1.6.
1.6. Next,
1.8.
1.8. Next,
1.8. 1.8.
1 point what?
8.
1.8. Next,
It's also 1.8.
1 point what?
8.
1.8. So what is the profit after tax? What is the profit after tax? Let me see it.
5.6.
5.6. Let me see, do you have a question?
Yes, I have questions. Yes, sorry. How do you get those operating profit figure?
So how many percent is the operating profit? How many percent? What did they say about the, how many percent is the operating profit?
8%.
Operating profit
9%.
So, yeah, 8%
8.
of sales. What do you have?
That was
Oh,
6.8.
I'm coming in.
So,
Times 84. 6.72. Okay, approximation.
let's move on, please.
6.4.
Honestly, the network is bad. Ba- Barely hear you. Favor.
It's 6.4.
6.4, 6.4.
Okay, 6.4. Next.
I guess you can't hear.
Hello?
Yeah, I can hear you.
Good. Yeah. The rest is
Favor.
7.7
7 point what?
7.2 for the remaining ones.
Okay. We add back non-cash item. Cash expenses. Right? So which is depreciation? Don't forget, our depreciation our depreciation is equals to the annual replacement of non-current assets annually. So in this case here, your annual depreciation is 2.0, then it is still equivalent to the replacement of non-current assets. It is still what? Equivalent to the replacement of non-current assets, right? So what is it? We have 2.0, 2.0, 2.0, 2.0, then 2.0, right? The next one is incremental non-current assets. Now, do you know how we arrive at incremental non-current assets? Incremental non-current asset is given to us in the question, and it was stated that incremental non-current assets is percentage of sales increase. Class, what is the percentage of sales increase? 80 for 2020 minus 84 times the percentage will give us the incremental non-current asset. You do the same thing for year 2. What is the increase? 87 minus 84. 87 minus 84, it's supposed to be 87. It's supposed to be 87 minus 84. Class, it's supposed to be 87 minus 84 times the 6%, we give what? The incremental, right? Class, am I communicating? So, hello, are we still together?
Yes, sir.
Okay. So the next one is 90 minus 87. 90 million minus 87 times, what is the percentage? What is the percentage for year
3.
3?
3%.
3%.
Okay. You can see that the question is kind of technical, right? Because if you don't understand all these terms, if you don't understand these terms, that okay, they say percentage of increase, some will just go and use, some students will go and use this 84, multiply by 84, then they will move on. But you've forgotten that you've increased this 84. What is the increase? So give me figure. What do you have here? Excuse me. What do you have? Figure
0.2.
0 point. 0 point what?
Jesus.
0.1.
0.2. The second one, 0.18.
confused. Share is 0.1, right?
Yes.
Okay.
0.18.
She says 0.18. The other
It's actually 0.09. 0.09. That's what I got.
Yeah, for the second year, 0.18.
this one, this 0.18.
Yes.
Approximate, when you approximate it, what?
0.2.
So what of this?
0.1.
Okay.
0.04.
Next, what do we have here? 92
0.04.
minus 90. 0.04.
04.
Next.
Same as 2024.
Okay. So we move to
Hello, sir. Sorry, please.
Yeah, I feel there is no
So this
increase.
last year is it not zero?
Hello, sir. I
For the
think we should
last
be
year,
consistent in these decimal places. We are using just one decimal place, but I'm seeing under 2024 we used two decimal place. I don't know if anyone could.
any decimal place that you want to use, please go ahead and use it. Right? Any decimal point that we want to use. So it seems the network is actually adding to what we have here, right? So any decimal point that you feel you want to use it. In fact, if you just want to use all the whole figure, 56 million, put it there, right? Then that one is approximation sign and all those things. Then the next one is someone was raising one point
So
again.
please,
Someone
2025
raised
is
another
zero.
point.
yeah, I
2025 is
feel
zero.
It's just
there's no increase in 2025.
okay, okay. Any other thing? Okay. So we have incremental working capital. If you see that maybe you notice that this approximation will affect your work or will affect you, you don't even understand how it works. Just use the one you understand. Even if it is 10 decimal place, write it and move on. Right? Please. So incremental working capital. So we're told that the working capital will incremental working capital as percentage increase in sales, right? Is that not so? So the same thing we did for this. So right? So the percentage is different. There are different percentage, right? They give us different percentage. Okay, okay, that's fine. So I can copy all this and paste. So what is the percentage for the first one?
6.
6%. What is the percentage for the second one?
5.
Yeah, 5. For the third year,
4.
4. So you can give me figure. This one should give me for year 1, year 2, year 3, year 4, year 5. This is year 1, year 2, year 3.
0.24.
0.24.
0.24. Next.
0.1.
1.5.
0 point what?
1.5.
Next.
0.12.
You know we are not consistent with our decimal place. 0 point what? 12.
2.
You know we are not consistent, right?
Yes.
Okay. Okay. What do you have here?
0.08.
0 point.
08.
Next. 0 point. Next is what? What is the last one?
0.
So we are done with this part, right? So what do? We have our free cash flow, right? We have our free cash flow. Class, don't forget the reason why we have to calculate free cash flow to the firm. Because ideally, the question says that it is using the shareholder value analysis, calculate the equity. Is that also value of APL? But the weighted average cost of capital given to us, they give us weighted average cost of capital, but there's no, what is it called? The cost of equity, right? I think if we have that, we would have said, oh, this is free cash flow to equity, right? This is free cash flow to equity. We get the market, we discount, we have the value. Is that also class? So in this case now, don't forget, shareholder value analysis is also a technique for valuation of what? Of a business. It's also a technique for valuation of a business, right? So the question could say, okay, calculate the value of equity. Now, what you need to do is that, okay, what are the information given to you? What are the value drivers? You should know that the value drivers given to you will be in line with the free cash flow. Class will be in line with what? The free cash flow. Now, so what do we have? What is the free cash flow to the firm? Hello?
First, 7.
Hello, the network is not fine. What do
Sorry,
you have here?
I don't think the incremental for 2023 is correct. Though.
Okay. Which one? The incremental for which one?
2023.
2023. Okay. Let's go back. 2020. I'm coming. Let's check it again. 90 minus 87. 90 minus 87 times 4%. What do you have?
0.12 now. Understand.
0.12.
Okay. Okay. And we forgot to add a replacement. We forgot to add a replacement.
It's not for working capital I'm
Replace.
talking about. It's for non-current assets.
Okay, it's for non-current assets. Okay, let's check. For year 3, right? 90 minus 87 for year 3. This is it. This is for year 3, 2023. This is 2022. This is 2021. Please, someone should confirm.
0.09.
Okay, for 0.09.
Yes. I think the answer given was approximated.
Okay. Okay. 0.09. Okay. That's fine. The person that asked the question, do you get that?
Yes.
Hello? Okay. So, replacements, all right? Replacements. What is the replacement given to us? Don't forget, will be equal to annual replacement. So, which means that your annual depreciation will be equal to your annual replacement. That is why I say this question is kind of technical. The first part of it is this sales increase. The second part of this is how to treat this part. The annual depreciation equal to annual replacement of non-current assets. So your annual depreciation will still be the same thing as what? Your replacement cost. 2 million. And we're not told that it will actually increase. Is that not so? We can have 2 or true. So I can copy this from this part and say replacement. Oh, we're supposed to put it in brackets, okay? Replacement of non-current assets. So now what do you have? If you subtract it, please favor when it is 3 minutes to end the call, please let me know. Meeting, let me know so I can create another link so we can complete this question, please. Favor.
I'm with you, sir. Okay, sir.
Okay. So what is the free cash flow to the firm? Class. Please, if you know you do not understand, let me know so that we can check it together, right? I can explain to you again. If you know you don't understand, let me know. Just say IB, I do not understand.
I did not understand. Sorry.
Right?
No, sir.
You say?
No, sir. That place that you wrote, add cash items. Did you mean to write add non-cash items?
Yes. My guy,
Sir?
you go do them
No.
now. And at the same
I
thing,
was a little bit lost from that place, so I didn't
ah,
remember.
ah,
Yes, sir.
we started, we started free cash flow together. Uh-huh. So it could be a
Yes, sir.
mistake. Then you can now non cash expenses. Add it back. Okay, please. What do I have quickly,
Mr. Ibrahim, the replacement you
ma?
included, is it part of our format in our free cash flow?
Yes. Replacements. I added replacements. If I did not add it, go and add it. Replacement of an asset. I added it. Did you check?
Okay,
I
sir.
added it. I'm sure that I added replacement of non-current assets. If there's, you replace an asset, now is that not so? So what is the implication? Is like it will reduce your cash flow. Even if I did not add it, replacement of non-current assets will reduce your cash flow. And that is why you need it. Do you get?
Yes, sir.
Yeah. Okay.
Sir, one more thing, please.
Benjamin. Okay.
I wanted to say this depreciation, the increase, you said the depreciation. That I was thinking, if depreciation is already included in operating profits, in operating expenses, and it has increased over the
Mm.
years, that means depreciation has also increased as part of it.
No, part of the formula, don't forget, add back non-cash item.
Yes, sir. So
Do you
yes,
get?
I get it.
It could be
But
that,
in the other
it could
cash
be
flow,
that,
we're increasing the depreciation year by year to add it
no,
back.
it's because It's because of different question, my guy, senior man.
Okay.
See,
Oh.
this question says that depreciation is equal to annual replacement. Equal to annual replacement.
I think
We were not given any percentage that depreciation will increase.
I understand, sir.
Do you
Yes, I
understand?
understand. It's just a technicality that I'm trying to bring. Maybe you can
Y-
clear it off.
Yeah, you understand.
Yes, yes,
Thank
I
you.
understand.
Thank you.
It's just a technicality that
Thank
because
you.
in my head I'm thinking, okay, if depreciation is part of operating expenses and is increasing year by year, so shouldn't we like increase this 2 million every year to
Un-
add back?
unless if you want to set question for yourself,
Okay,
no
okay. No,
problem.
that's why I
You can
wanted you
increase it.
to just clarify it. You better make a clear and
Okay.
for me to carry on for hard.
Yeah. Okay, favor is 2 minutes, right? That's fine. It's 2 minutes, right? That's okay. Benjamin, maybe when we come back, please, when we come back, I will answer your question, right? So just hold on, right? Just hold on. Thank you. We need to create another link now. Sure.
I've been trying.
Okay. The reason why I asked is because the question says equity. You have to prepare free cash flow to equity normal. That is what you should do. But what you will use to discount the free cash flow to equity is not given to you, which is the cost of equity, right? If you go back to the last class on merger and acquisitions, the same thing occur. So most times when you are valuing a business, the question will not come straight like that, right? Now, the question says, what is the equity using shareholder value analysis? You are using a valuation. It is valuation of a business, right? From there, you will now pick it. Okay, what is the part of the required? Oh, is it equity or to the firm? Now, if it is to equity, when you given all the information, of course, free cash flow will remain free cash flow. Unless if it is free cash flow to equity, you will not if it is free cash flow to equity, you will not include what is it called? Interest. Is that not so? Now, if
Yes.
that is established, the question says equity. Then you are given the weighted average cost of capital. So what will you do? It's for you to prepare free cash flow to the firm. Remove don't forget, I don't know if you are with us in our previous lecture, that when you determine the free cash flow to the firm, it means that it is the combination of both your equity and debt. Your total market value include the total market value of debt and equity is equals to the total market value of free cash flow to the firm, because it includes both equity and debt, right? So we need to remove the element of debt, right? If you are with us in the previous lecture, right, we need to do what? We need to remove the element of debt so that we will now have free cash flow to what? To equity. Now, let's do something. Before that, that is a very good question, although we've been doing something like that before. Now, let's quickly go back. Let's check something here. Where is it? Okay, let me do something briefly. This is it. Total market value or of the firm is equals to your total market value of debt plus total
Equity.
market value of equity. Is that not so? Now, you need to remove for you to get the market value of equity, you already get, when we get the total market value now, you get for the firm. Is that also? Then you make, you say, what is the total market value? From there, what is the value of debt? When you minus the total market, you just make the total market value of equity the subject of the formula. You have your total market value of equity. So why do we have to go through this route? It's because we were not given information as to the cost of equity that we will use to discount the free cash flow. And if the cost of equity is given to us, so we don't need to go to free cash flow to the firm. Then we now, no, we don't need to go back to free cash flow to the firm. Then we'll remove the portion of debt. So in valuation of a business, when questions say value, either free cash flow to equity or free cash flow to the firm, you use the normal format. Right? So because the question actually stated, it said equity value, right? Then you are supposed to use free cash flow to equity. But where is the cost of equity? It's not given. We were given what? Weighted average cost of equity, weighted average cost of capital to the firm, right? Which means that you still have little work to do. Calculate it. Calculate your free cash flow to the firm. The total market value include your total market value of debt and what? The total market value of equity. Then make it the subject of the formula. Remove the debt element, the total market value of debt. So when you remove the total market value of debt, you have your total market value of equity. Then when you want to determine the equity per shares, divide it by the numbers of shares. Class, am I communicating, please?
Yes.
Right? Please, do you get that?
Yes. Thank you.
That's fine. Any other question, please? Benjamin, go ahead. Benjamin, please.
Yes, sir. Is on this incremental non-current
I can't hear you.
Can you speak clearly? Hello, can you hear me now?
Yes, go ahead.
Okay, my question is on the last figure under incremental non-current assets. From the question says from 2025 till infinity, it's 0% increase, right? So I discovered under the operating profit side, we repeated the figure of 2024 to be the same as 2025 plus. But when we came to incremental non-current asset, I was expecting that 0.04 to be repeated, but we wrote 0%.
Well,
So
why?
I don't know why.
So what is the percentage?
Yes.
You see, that is part of the technicality of this question. What is the percentage increase? That is that part. What is the percentage increase? Now, the percentage increase in the operating profit is 10%. Is that not so? The percentage increase is 10%. So for the incremental working capital is 0%, 0%, which means that your sales for 2024 minus your sales for 2023 times 0%. Anything times 0 is 0. So the one of operating profit margin, you can see that the one of incremental non-current asset is also 0. Is that also? It's 0. Do you get that? Hello, Benjamin.
Yeah. I was going through the question. Yeah, it's fine now. Thank you.
Okay. Please, any other question, please? See, one thing I like is you need to ask question. Do you get? Question? Ask me this question. I see anything I don't know, I will tell you. I will tell you that. Don't worry. Maybe when in our next class, I will tell you that. Okay, this is how we need to do it, right? Just you must ask question, right? When we get to intensive class, you must ask question. you must ask question, right? Okay, go ahead, Ruth.
Please, I don't understand. We got the figure for non increase in non-current assets. This 0.2, 0.1,
But
0.4,
you understand,
0.08.
but you understand the one of working capital. Do you understand the one of working capital?
No, sir.
Okay.
No, I didn't
Are
get
you
it, sir. The both
are you
of
with
it.
the question?
I
Are
didn't
you
get
with the
both of it,
question?
sir.
I'm coming. Are you with the question?
So I didn't get both of it. The working capital and the non-current assets.
I'm not asking you question now. Are you with the
I'm
question?
confused with it.
I'm coming. Are you with question
Hello?
now? Are you with question?
Yes, I'm with it. Yes, sir. I'm with
Now,
questions, sir.
okay, that's fine. Do you know why I will answer this question? I'm not supposed to answer the question. No. Do you know why? Because I've actually explained it. But let me just explain again. The question says incremental non-current assets. Non-current assets as a what? As a percentage of sales increase. This is just if we don't understand the sales increase, what is sales increase? The sales increase is in 2020, the sales was 80. In 2021, the sales increased to 84. The question is, what is the increase? What is the difference? That is why we have 84 minus 80, because the question says
Yeah.
percentage increase. 84 minus 80 times, what is the increase? 5%. When you do it like that, you have your figure. The same thing applicable to non-incremental working capital. If you do the same thing to the year 2022,
Okay.
87 minus 84, right? The 87 minus 84
Yeah.
times the increase, which is 6%, you have the figure up, right? So apply the same thing with incremental working capital.
Okay.
Thank you. So can
Thank you,
we
sir.
move ahead now? Hello, class. Can we move? Okay.
Yes, sir.
So what is the free cash flow? What is the free cash flow?
$5.16.
5.16.
16.
Next.
6.05.
6.05. Next.
6.98.
Uh,
Next.
7.08.
Okay.
7.2.
So what is the DCF? The weighted average cost of capital given to us in the question. 10%,
10%.
right? So what is the DCF? for year one?
Zero point nine zero nine.
0.909. Don't forget that we are not consistent with our figures here, right? We are not consistent, so you can do that, right? I don't just want to go back and readjust all those figures, right? So anything that you want to do, if you want to use 2, be consistent with 2. If you want to use one decimal place, use 1. If you want to write the whole figures, 5,600,000, write it. So what do we have again? What is the DCF? What is the DCF?
0.751.
Okay, 0.7
No, that's
0.751.
for the third year.
Okay, what of the second year? Please,
Zero
someone
point two six. 0.826.
0.826. Fourth year,
Fourth year. 0.683.
0.683. So don't forget that the last year is beyond, that is to infinity. Is that not so? Class, I've analyzed this question, right? That sometime, I'm coming. Okay. Now, why is it infinity? I have to repeat it again because there are some questions again that may come like this, right? 4 year. It is supposed to be 4 year, right? Then why do we have 2025? See, even if they did not put this plus, you should know that why 2025? It is 2020, it is for 4 years. So which means that anything after 2024 is beyond, that is to infinity. Class, am I communicating, please? Am I
Yes, sir.
communicating, please? Now, so what is the so let's calculate what is the infinity.
Infinity.
So what is the infinity? uh let's use annuity. Let's use annuity formula. Let's see. What is the annuity formula?
Sir, they did not say when the was it will grow beyond the
They didn't
15
say the
percent.
years.
Is infinity, right? This is
Yes.
beyond. Is that not so?
Yes, it's beyond
Beyond
this infinity,
2025.
2025 to infinity.
Okay, don't worry. Let's do it this way. What is the annuity formula? Let's see. Let's see.
1 minus 1 plus r.
1 minus
1 plus r
1 plus r. I want to
raised to
test
power,
something if it will work. I've forgotten something there, but
raised to
let's
power
see.
minus n
Okay.
over
Please,
r.
if you know how we can calculate it, I've forgotten something there, and I'm trying to recall
Is it
something.
not, what is it called now? Amount over the rates for infinity.
Uh, to infinity, right? No.
If
The
there is
reason
no
because
growth, if there is no growth,
we want to get the DCF. Do you get? We want to get the DCF. Is that also?
can we
Mm,
get the DCF when there is no growth?
yeah, we can get DCF now. Why not? Why not? Why not?
Sorry, sir, I thought we are supposed to use the same DCF for
No,
year
we can't
4.
use the same DCF, sir, because this is beyond. So the DCF should be different from the normal one. Do you
Can
understand?
we use assumption on this in
Not,
particular
not
cases?
too clear, sir.
Year to
No, you
infinity
can
is not
use
this.
Hello, sir.
I'm coming. You can use the same DCF because the 2025 is beyond. It does not follow the normal DCF. So you can use it. It is beyond. It is infinity. This one is for year one. You can say this is for year one. You can say this is for year two. You can say this is for year three. You can say this is for year four. But you can't say this is another one for year five because it is infinity. The 2025 is beyond. Exclusive.
Yeah, sir, I understand what he's trying to say. Like, we are supposed to use year 4 DCF just to discount it, but then there is no growth. So that's what I'm saying. Since the cash flow is static, there is no growth. So maybe we use the what's it called now? Ah,
So use annuity. Just use
Sir, can
annuity.
this place in the exam hall, can it be assumed?
No, let me
Like, can we
check.
use
No,
assumption on it?
no. Which basis of assumption did you want to use? Let me check. Let me check. Where can I see this thing? Oh, let me check. This at the back of the question. There's one formula I'm looking for. There is formula for calculating infinity. There's formula for calculating infinity itself. If you want to get the DCF
that's
for
what I'm
infinity, there is a formula for it. This is what we will do. This is what we will do. Okay. Now what is the DCF for year four? Let's do something. There's formula for infinity. There is formula for infinity.
Sir, do
That
you
is
mean
what.
perpetuity? Is it perpetuity?
Yeah, perpetuity. Yes, perpetuity. Exactly.
1 over
Exactly.
R. 1 over R.
Okay, it's 1/r, right?
Yes.
Okay. There is
yes.
something. Okay. Uh, uh, hmm, uh, I want to do something. 1/2. Don't worry, we understand. So the DCF from where is capital letter from year 1 to 4. What do we have? Coming if it will work like this. I'm just thinking of different approach, right? Okay. 1 divided by what is the rate? It's 10%, right? 0.1. What do you have here? 1 divided by 0.1. Still have something. No.
10. It's 10.
It's 10. We have 10. We have 10. There's a formula for it.
Fine.
I'm just trying. I've forgotten the formula. Forgotten the formula. There's a formula for it. Okay. Okay. This is what we do. This is what we do. Let's just so it will not waste much of our time, right? Tomorrow we have class tomorrow. It should be good for me to complete this question. Uh, get this question.
Hello, sir.
Yeah, me too.
Okay. I would trying to do annuity for year 1 to 4. then the perpetuity, then we'll less to get the discount rate for that one, or what do we?
No, we are not supposed to less. We are supposed to add because this is like this 0.68.
No, if we are using annuity, sorry, I
Mm,
don't know if I'm not correct. If we are using annuity for year 1 to 4,
okay. Now let's use it. Annuity from year 1 to 4. What do you have? Annuity from year one to
that,
four.
that
Annuity
should be
from
have 3 point something. Let me calculate again because I just did. One, that's 3.170.
170.
Yes, approximately 3.170. Then I want to infinity, that is the perpetuity, we have 10.
That is 10.
Yes.
3.170 plus 10. That is 13. No. No. Okay, this is what
No,
we do.
I think it should be less. We shouldn't add, we should
No, no,
less.
no, 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 no. 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 This is what we do. I think I need to. We need to go. Let me just end the class, right? Yes, something is just coming to my head, right? I just need to go and check something. Let me check something what happened there. Since we're not able to get this part, I will not be able to continue the class. But it would have been good for us to complete this question. Oh, okay, that's fine. That's fine. That's fine. It is part of the challenge, right? So it is part of the challenge. So let's just go and check, right? Let's check it together. Tomorrow we'll continue from there before we move to the introduction to foreign exchange. Introduction to foreign exchange. We're supposed to complete this question, but it's fine. It's sometimes it happens like that, right? It happens like that, But it's perfect. Let's go and do the research work all together. But I know that I did it somewhere. I did something like that somewhere, but I can't remember anymore. But it's fine, fine. So thank you so much everyone for joining. I will upload this particular class, right? We'll upload it to the on the YouTube so that you can go there and do what you watch. Then tomorrow we will continue from there, right? So tomorrow's class. Welcome to another edition of Strategic Financial Management. In today's class, we shall continue with our lecture on shareholder value analysis. Then it is normal for us to have probably little challenge. Right? We had that yesterday. We're not able to determine the infinity, right? So because the 2025 beyond, that is to infinity. Don't forget, I equally mentioned that even if this 2025 plus is not there and they just say 2025, you should use your discretion that the competitive advantage for this company is for 4 years. The question you should ask is why 2025? That 2025 is what? Beyond, right? And another person asks a very good question that how do we know that this question is free cash flow? he actually mentioned that free cash flow to the firm, and I answered the person that no, it is not actually free cash flow to the firm, but because of what we're given in the question, we're given the weighted average cost of capital of the firm. So the question says that is the equity. Now, since we are to do that, we need to determine the free cash flow to the firm. And don't forget, when you determine the free cash flow to the firm, the total market value using the free cash flow to the firm is equals to the total market value of debt plus the total market value of equity, right? And I said that since it is like that, calculate your market value of the free cash flow to the firm. What you need to do is to deduct the element of debt. You should have not go that route, because if they want you to determine the equity straightforward, you should have been given the cost of equity to discount. You know that, okay, there will not be interest, and you do your cost of equity. Then you divide it by the numbers of shares. But then the cost of equity, the ingredient to calculate cost of equity is not given. We're only they give us what? The weighted average cost of capital. That is where the technicality of this question, right, comes from. How do we now determine equity when weighted average of cost of capital is given? Don't stress yourself too much. Calculate the total market value using the free cash flow to the firm. After that, remove the portion of debt. But in another case scenario where you are given the cost of ingredients to calculate the cost of equity, well, use it just like the way we normally do. Use it. Divide it by the numbers of shares. Get your equity market value of equity per share, and you move on with that. Then you do your infinity and all that beyond. Right. I just needed to explain that again. Class, am I communicating, please? Right? Am I communicating?
Yes, sir.
Now, if that is established, so in this case now, we want to determine the DCF to beyond, right? Now, our usual way is like we pick the last, since this is DCF class, since this is DCF, I didn't mean it is value, would have picked 7.2, right? Now, in this case now, what is the last DCF? The last DCF here is what? 0. What? 683. So any day, anytime you want to do that. So beyond DCF, beyond, right? So is equals to, what is the last DCF is 0. What? 0.683, 0.683 times the infinity. So what is the formula for calculating perpetuity? Let's say perpetuity formula or infinity formula, right? It is usually 1 divided by r. So your 1 divided by r, that is 1 divided by r, which is the DCF, which is the 10%. So this will give us 10, right? So we can have 0.683 times 10. What do you have? When you multiply this, what do you have? Figure
6.83. 6.8.
6.83. So, right. So we can have 6.83. Don't forget the usual way. We normally pick the last. This is DCF, right? Just pick the last, right? Pick the last DCF, multiply it with the perpetuity figure, the perpetuity. So once you multiply it, you have your DCF beyond. Any day, anytime you want to do that for DCF, this is what you will use, right? Pick the last DCF, multiply it by the infinity, the perpetuity, then you have your what? You have your DCF for that, right? Now, if this is established, what will be the value? What will be the value when you multiply? I need figure, please. Figure.
The first one, 4.690.
4.690.
The second one, 4.961.
4.961.
The third one, 5.242.
5.242.
Then the next one, 4.836.
4.836.
The last one, 49.176.
49.176. 49.176. Okay. Class.
Yeah.
The year 2, I'm not sure it's correct. But 4.
Okay, let me check.
4.997.
Yeah, 4.97. 4.961. So I think if we approximate to 2 decimal places, then we have 4.97, 4.96.
No, let's just leave it. We're already using 3 decimal places.
4.997, boss.
Okay. So, what is the total market value? Total market value from which year? From 2021 to 2025 beyond. Please, do you have anyone who was in class yesterday that they don't understand what we are doing? Except those that are just joining us now. That in class yesterday, you did not understand all these things. You can raise your hands up. So what do you have? I can explain to you. What do you have? Figure. Please, is this 7? Is 49, right? Is this correct? 49.176.
Yes, sir.
Okay, that's fine. So figure.
68.941.
68.941. Did you, please, who checked this question yesterday, that the suggested solution? Did you read the examiner comments? The person, do you have anyone that checked the suggested solution? None? Okay. So you can check the examiner comments. Okay, I will check it. We'll read it together. Right. So please always pay attention to this there are some areas they will just give you small question. It is kind of technical. If you don't read it to understand, you will miss it. Now, this total market value is for the firm. Class. Total market value for the firm is for the firm, class. And don't forget, please always make sure you understand this thing. Can you see it? Total market value equals to of the firm consists of both your debt and equity. But the question says that what is the value of equity using SVA? Which means that we need to remove the portion of debt. Unless the reason why you don't need to remove the portion of debt, maybe the cost of equity is given to you, then you know you have to use free cash flow to equity. But in this question, just the weighted average cost of capital, then you will not be asking yourself, how will I calculate? It's just weighted average cost of capital that is given to me, that is given in this question. You don't know that you need to unlock, the question by calculating the total market value for the firm. Then you remove all your debt. You can see that the debt here, what are the debts? What are the debts? Can you see that the current market value is this 95 naira per share? This is nominal value, and this is the cost, right? Now, we need to have another problem. There is a challenge here again. This is debt. You know, Adimbin is in percentage now. We would have just looked just like the way we did under the merger, the other question, right? We would have just say, okay, the total market value is 60%. We just say, what is the 60% of the total? We'll remove it, we have our value of equity. But in this case, we're given the short-term investments held. Short-term investments held, 0.8. The current market value, debenture, is 10, right? Now, how do we determine the market value of debt? Class, can I use this 10 million as market value of debt? Is it okay to use that? The
No.
10 million. Okay. So if it is not okay, so how will I determine the market value of debt?
Since they gave the market value and the nominal value, I feel we should just do the normal 95 times 10 million over 100.
Okay, exclusive. So choco. If you say 95 naira times 10 million, exclusive. Can someone give me what is the market value? How do I determine the market value? How do we determine the market value here of debt?
35 divided by 100 times 10 million.
90 what? Sorry, favor.
5 divided by 100
95 divided by 100
times 10 million.
times 10 million. Okay. Interesting.
That was what I said now. Like 95 times is 10 million over 100.
Interesting. Can someone give us how we will explain to us how we will determine our market value here?
Sir, I'm not too sure, but I just want to say this. I feel we should get the number of stock, then we multiply it by the current market value.
See, thank you, Rachel. Thank you so much. Um, what I will do for you, I will return, I will return something back to you. Don't worry, we'll talk privately, right? Thank you, right? Thank you. And you have, you see, you have, a special gift for me. Like, like seriously, that is a very good one, right? Because it is what we have been doing before now. It is what we have been doing before now. Class. under the cost of capital. This is like a capital structure. 10 million the cost, the nominal value. Get the numbers of stock. When you get the numbers of stock, what is the market value per 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 stock, right? Debenture, right? It will be 95, it will be 10 million divided by 100 will give you number, right? Then market value per one times 95. That is another problem here. We've been doing something like this before now. Is that not so, class? Hello? Hello?
Hi. So, but it's actually the same thing if you are going by what she said.
Which one? But which? How? Okay, by what?
Like the 10 million divided by 100. If you still do the 95 times the 10 divided by 100, it's
No,
still the
95.
same.
No, wait, I'm coming. The exclusive said 95 times 100 divided by 10 million.
95 times 10 over 100. That's what I said. Oh.
Oh, you said 95 times 10.
95 times 10 over 100.
Okay. Favor, is that true?
That's the same thing I said also. The same thing. It will give us the same answer.
Okay. I thought you said 95 times 100 divided by 10 million. Okay, that's fine. That's fine. That's fine. But I can't reverse what I said now. That's fine. Or favor. Okay, let's move on.
I'm with you, sir.
That's fine. So, but the normal approach you should have used is just say, okay, 10 million divided by, you get the numbers, they multiply. So, when you are doing it like that, people will understand, like, will actually understand what you do, right? Nice one. Well done. So, market value of debt, right? 10M divided by the nominal times, um what is the market price? 95. What do you have? What is the market value of debt? What is the market value of debt?
It's 9.5.
Okay, 9.5. Oh, coming. 9.5. 9.5. Okay, 9.5, right? I need to share my screen again. Sorry. Share entire screen. Okay. So 9 point what? 9.5. Now, what about these short-term investments? Where are we going to treat it? Are we going to treat it as market value as well? Are we going to deduct it uh from this short-term investment held? Is it a debt? The short-term investment, class, how do we do it? How do we go about this short-term investment?
Good morning, sir.
Good morning.
Yeah, for me, because the short-term investment had to do with the firm as a whole, and we are looking at just the value for equity holders. So I think we should take it out.
Okay,
Anything that
okay.
has to do with the firm completely, we have to take it out.
No, not
My,
not not the firm completely. The short-term
as
investments.
in this case is
Yes.
what I'm talking about.
Okay. That's fine. That's fine. So, any other person, uh, the short-term investments. So, do we agree with Eda? Hello.
I think that short-term investment is actually a debt, so you
Okay.
need to like remove it out.
Okay. That's fine. So, short-term investments. Short-term investments. So, what is the short-term investment here? What is the 0 point what? 8. So, what do we have? What is the value of equity now? Market value of equity, right? So that short term could be their short term what investment, which could be like a debt to them, right? So what is the market value of equity? What is the market value of equity?
58.641.
58 point what?
641.
641. Okay. So this is the market value of equity that we have. And this is how many marks? This is 12 marks. So what is the examiner comment? Let's check. This question tests candidates' knowledge of the computational aspect of shareholder value analysis. Candidates are expected to calculate the free cash flow using SVA and value of the company. Only very few candidates attempted the question. Based on the candidate's performance level, it is clear that candidates do not have any knowledge of the subject matter. Performance in the question was therefore extremely what? Low. Poor, right? That is very poor. And that is what that was the examiner comment. Oh, they didn't even remove. Okay, it was they add back the short-term investments. Okay. What could have happened to short-term investments? Okay, let's go back. Short-term investments. What could have happened? Short-term investment held. Now, so I think from 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 our financial statements, don't forget that short-term investments will be treated as part of current assets. Short-term investments you because you it could be that you buy shares. Let's say it could be that you buy shares and or it could be commercial paper, right? It could be treasury bill, probably for 3 years, right? or let's say it is not a commercial paper. Let's say because they are part of debt instrument, right? Let's say you buy shares. Let's use a debt instrument, right? Equity instrument, sorry. You buy shares, right? And that shares probably is for maybe for capital appreciation for 5 years, for maybe for I say 5 years, maybe for a month or 2 years or 1 year. So the short-term investment, it is treated, you can check it. I just remembered. Apologies for that, right? I was thinking of so many things, so many factors that could cause that. Short-term investment out is part of your current asset. It is not a debt instrument, right? And what could lead to the short-term investment could be investments in shares. Because of the market is volatile these days, you could see that some investors are going to the market to draw their what to withdraw their investments, right? To get back their investments because of the market. So please, the short-term investment is treated as what? As current assets. So therefore, it is not a debt instrument, right? It is an asset to the company, right? It is what they have. It is an asset to them. It is not a debt instrument. So, what is the final figure here?
60.
60.
241.
241. So that's it. If you are confused, you can ask your question. Ruth Temitope, she's part of those who say 10, 8. The class should start by 8. But she's joining 9:17.
Sorry, sir,
Interesting.
I was having a network issue.
Interesting. Okay. Oh. So class, are we good? Are we good?
Yes, sir.
Okay. So we are done with shareholder value analysis. In summary, in summary, shareholder value analysis is used to is the process of analyzing the activities of a company to ensure that the company maximize shareholders' wealth, or to ensure that there is an increase in the shareholders' value. Then, in order to increase the shareholders' value, there are 7 drivers that could affect the value. Don't forget that shareholder value analysis is another form of valuation. You can use it. And when you want to do a valuation, either you use free cash flow to the firm, to equity, all the types of all the methods that you have, assets, net base, and all that. Right. So picture the format of free cash flow. Then the question will now tell you where to go. Either it is equity. So once they say equity value, it is free cash flow to equity. But the question is, what you will use to discount that free cash flow to equity, which is cost of equity, the ingredient, is it given in the question? If it is not given, maybe for the purpose of, this question now, we're given what? Weighted average cost of capital, which is to the firm. Don't stress yourself. Just calculate the market value, total market value of the firm. Then remove the market value of debt. Right? When you remove the market value of debt, if there is any short-term investment as an asset to the firm, you add it. Then you have your market value of equity. This question could say, okay, what is the market value of equity per share? Just divide it by the numbers of shares. And shareholder value analysis, there are 7 drivers that could affect the maximization of shareholders' wealth under the shareholder value analysis, right? The sales, the operating, the replacement, increase in non-current assets, the competitive advantage, which is the life of that project, or the life of the project, the working capital, right? So, and that is it. So the B part of this question, I will leave that for you, right? We'll explain.
Sir, please, sorry, sir, please, can you repeat the 7 drivers again? Sorry.
Please, I've mentioned that yesterday. You can check back you can watch the video. Either
Okay, sir.
sales growth, operating profits, incremental non-current assets, increase in working capital, then the competitive advantage, the cost of capital, right? I think that's what we mentioned, right? That's what we mentioned. So, distinguished professional colleagues, are we good to go? Are we good?
Yes, sir. Yes, sir. We are good.
Comfort.
Please, Mr. Ibrahim, I'm going to upload yesterday's video.
I will do that immediately after this class.
Okay, thank you.
Today's on too, sir.
Okay, ma'am. What I will do is, what I will just do, I will end the recording now. Then I will just merge yesterday's and today class on shareholder value analysis together. Then so that we will now start new recording on the foreign exchange. The foreign exchange will take us to international investments. Don't forget that I will not go into the hedging part of it, right? That is why it is Ican exam. You have to be strategic, and that is what we're doing, right? I will not go into the hedging part of it. It's not that it is difficult, but because of our time, it is a wide topic, right? A very wide topic, right? So we need to use this our time to focus more on international investments, right? So we are good, right? So the B part of the question, I've explained that part of it yesterday. So the total marks 15 marks. So thank you.